housing market is in serious trouble right now. You see, the biggest part of this housing correction we've seen so far has been about affordability, and we've just seen affordability levels get even worse. So in today's video, I'm going to explain why the housing market is in serious trouble right now, what's going on with mortgage rates, why are they rising, and what we can expect mortgage rates to do going into the future. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. And with that said, let's jump into it. Mortgage rates are now up to almost 6.9%, which is almost a full 1% higher than where we were just back on February 2nd when we hit lows of 5.99%. Now, this is of course a huge deal because for every 1% that mortgage rates go up, buying power decreases by about 10%. Now, up until recently, it was looking like affordability levels were continuing to trend down. As we saw ever since mid-October, we've been seeing that mortgage rates have gone down from a high of 7.37%, which is the highest levels we hit, now down to recently we hit as low as 5.99%. And in addition to that, we've also been seeing the median sales price trend downward as well, roughly around 11 to 13% from all-time highs. Now you can see right here on the latest report from the National Association of Realtors, they release a housing affordability index every single month, tracking the affordability levels nationwide. And you can see here that we hit the peak levels of unaffordability back in October of 2022. This was when the median sales price was at $384,000, and we were seeing an affordability index level of 91. Now, for those not familiar, back when we had the 2008 housing crash taking place, the lowest levels of affordability we saw back then were hovering around the 100 level as far as the affordability index is concerned. So coming in at a 91 is even worse than those levels of 2008, and so we were at extremely unaffordable levels. Now recently we have been seeing it tick up. In November it ticked up to 94, and the most recent data we got was for the month of December, where it ticked up to 101. Again, a little bit higher, but still not great levels overall, historically speaking, because we're hovering right around where we were at the 2008 recession. Now, with mortgage rates starting to trend upwards again, I think what we can expect to see with the affordability index is it's a little bit delayed. As you can see, we're getting data for December in the month of February. So we're going to see January data come back. That's probably going to come back even more affordable than it was in December between the lower median sales price and the lower mortgage rates. But then in February, we're going to start to see that number tick up again, which we won't get that data till probably April time, because now with mortgage rates going back up again, they've gone up again from 5.99% of the lows, now up to about 6.9%. That drastically affects affordability. Now, what's been the main driver of mortgage rates starting to trend back up again? Well, what it ultimately comes down to is our battle with inflation. Now, we know that inflation has been a big problem in the US. We hit a high of around 9% back in June, and it's been trending down slowly since then. And so we've started to get the feeling that maybe the Fed might pivot sometime in the near future. At least a lot of investors have been feeling that way. And so because of that, they've been thinking a U-turn's around the corner. And so as a result, that information has been baked into mortgage rates, and that's caused them to trend down recently over the past several months as we continue to get more and more positive inflation data back. Well, that completely changed when we got some shocking inflation data back for the month of January. We got that in the month of February, and when we received that data that showed that inflation was hotter than expected, we expected it to come down to about a 6.2% level, came back at a 6.4% level, which although it is slightly better than where it was before, it still came back hotter than expected, proving that inflation is getting a little bit harder to fight at this stage. And we've talked a lot about this on the channel, that as you go down battling inflation from 9% to 7% is going to be easier than going from 7% to 5%, and then going from 5% to 3%, and eventually to 2%, which is their target goal. And so right now we're seeing it's harder to get down from those 6% levels down to maybe 4% levels. And so as a result, investors are freaking out because maybe it's not going to be such an easy path to a Fed U-turn, a Fed pivot taking place, and we may be in for a longer economic recession than initially anticipated. We've also had the Federal Reserve Chair Jerome Powell state over and over again about how they're going to continue raising interest rates, maybe at a slower pace, but continuing to raise rates throughout 2023. And they definitely will not cut interest rates. And this was a unanimous decision across the whole entire Federal Reserve Board that they will not cut interest rates throughout 2023. Now, add to that, the St. Louis Fed President James Bullard was on the record saying that he wants to raise interest rates another 0.5% at the next meeting, which is more than what was initially anticipated. So again, all this information is getting baked into the mortgage rates that we are experiencing today. And as things like that come out, as things like the inflation data come out, and we get more jobs reports and consumer reports back that are coming in hotter than expected, all of that information gets consumed, and that affects what mortgage rates end up coming back at. This is because the longer we have an issue with inflation, the more aggressive the Federal Reserve will get with their monetary policy, and the longer they're likely to be aggressive with their monetary policy, which means a more serious economic recession, which means a longer economic recession. Now, speaking of some of these reports, one of the reports we got back recently was numbers for PPI, and that's Producer Price Index. It's basically like the wholesale price that companies buy goods at. And so you can see here it has been trending down. You see, let me go up a little bit here. We were back in early 2022, we were as high as 9.7%, and it has been trending down. We're down to 5.4%. However, the number did come back hotter than expected. For January, we were previously at 5.8%, and although we went down to 5.4%, the expectations were for it to come back at 4.9%, and so it came back significantly hotter than expected. Now, even more shocking than that was the retail sales numbers we saw. This definitely had an impact on mortgage rates as well, and you can see here that we've been trending down as far as retail sales. These are month-over-month numbers. You can see 0.4%, 1%, negative 0.4%, and we started to see some, negative trending numbers as far as retail sales was concerned, and then out of nowhere, 3% gain month over month in the month of January. Now, this was all, again, a lot hotter than expected. We were expecting for it to come back at 1.8%. because normally we're going to see a little jump in January as far as retail sales is concerned, but we saw it actually come back at 3%. So although it was expected to come back positive, it came back a lot hotter than expected, which again caused mortgage rates to have more upward pressure on them. And just as important is the core retail sales number, because that specifies down to more discretionary spending, because this eliminates things like cars, gasoline, food, building materials. And as you look at that, we saw that the forecast was for a 0.8% increase as far as that's concerned. It came back at 2.3%. So again, a much higher than expected number for even core retail sales numbers. So essentially what's driving mortgage rates to go up at the moment is the belief that right now we are expecting the Fed to be even more aggressive than initially anticipated for a longer period of time. And this is of course bad for the economy, bad for the housing market, because as interest rates continue to go up, as inflation continues to be a problem, and as mortgage rates start to go up, it prices more people out of the housing market. That's more buyers sitting on the sidelines. So as of right now today, how is this already impacting the housing market? Well, one of the most up-to-date metrics we can look at to look into the future of what will happen with housing is our buyer demand. We have very up-to-date information with buyer demand, and right now buyer demand is going way down. You can see here in this chart right here, this shows the purchase application index right here. So you can see in December we were at levels of around 175. We were starting to go up a little bit as mortgage rates were starting to trend downward. And then we saw buyer demand, trickle down towards the holiday season, which is pretty typical. And then of course, right as we were coming out of the holiday season, it jumped up drastically. People thought buyers were coming back into the market. And ever since we started to see mortgage rates go up again, which was around this mid-January time, we've started to see the levels of buyer demand trickle down again. And now recently, as of the most up-to-date data, which again, this is for the last week's period of buyers, okay? So we got these numbers on Wednesday, February 22nd. So these numbers are based on the previous week, which of course is when we saw mortgage rates shoot up drastically. And so we saw the buyer demand drop to literally the lowest levels we've seen since 1995. So even at this point, if we have mortgage rates staying put where they're at, around these 6.9% levels, we can definitely expect more downward pressure on prices throughout the coming months ahead. But if it goes higher from here, when we reach those mid-October levels where we saw levels of about 7.37%, and we get beyond that, now we're at a point where we could be seeing a very serious housing correction on a nationwide level. So what do we have to keep our eyes on to get an idea of where mortgage rates are headed in the future? Well, again, like I've been talking about in today's video, it comes down to our battle with inflation. If we can reach expectations or do better than expectations on these future inflation numbers and job numbers and consumer numbers, then expect that we're going to start to see mortgage rates start to trend down again. However, if we continue to have problems with battling inflation at this point where we're at, then I would expect that mortgage rates are going to probably stay around where they're at, or maybe even possibly continue trending slightly upward. So with that said, I'm going to keep you up to date with all the latest information regarding the housing market, the economy, and what the Federal Reserve is doing. And so if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any questions or thoughts, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you on the next one.